hopefully, Instagram will not cut us off today. We tried one yesterday and it wasn't great. Welcome to Mini Masterclass Thursday on a Wednesday. We are coming to you on Wednesday because tomorrow we have scheduling conflicts, and so instead of canceling this week's Mini Masterclass, we are doing it today instead. So welcome. Thank you all for joining or coming back and watching the replay or finding us on our YouTube channel or LinkedIn. We so appreciate you coming and dropping by to learn all the things that you need to learn about your business and for your business during our Mini Masterclass. So today's topic is reasonable compensation. And the reason that this is something you should absolutely pay attention to if you are an S Corp or S Corp elect or C Corp, the IRS is targeting small S Corps or S Corp businesses. And the reason they're doing that is that they're just finding all kinds of compliance issues across the board that they now are going to focus on and address. And I'm hearing this information from multiple CPAs, tax preparers, people in the know, auditors. So I hope that this is finding you at the right moment in which you're now willing to take a look and actually do your reasonable compensation. What the heck is reasonable compensation? Reasonable compensation is the amount of money that you as an officer of a corporation are supposed to pay yourself on payroll. Not just take money out of the bank account, not transfers, not draws, but on actual payroll. So first and foremost, yes, that means you're going to pay taxes on it. And I know a lot of people say, I don't want to pay a payroll because I don't want to pay taxes. Well, you don't actually have the option. Whether or not you someone wants to play in the middle of my mini masterclass. Buddy, I can't. I'm working. We're working. Here you go. Sorry. Whether or not you want to pay taxes, you have to pay taxes. And partly how you do that is through payroll. And partly how you do that is through your K-1. And partly how you do that is any other forms of 1099s that you might pay taxes on if you're a contractor for others. So if you're an S Corp and you have a business, you need to do an annual reasonable compensation analysis. What this will do is tell you based on the IRS criteria, right? So this is not just like a formula that we make up and hope it works. This is IRS formulations, the exact questions that are going to be asked of you in an audit. And I actually have proof of this because one of my clients is currently in an audit, and I'll talk to you about that in a second. But proof in an audit of how you came up with the amount of money that you paid yourself. The reason that this is a thing is that there are just so many business owners that have tried to do what they call tax evasion over the years by not paying taxes on their money. And so the IRS came up with a formula in which to determine, okay, this is reasonable for what you do for your corporation, how much time you spend in your corporation, what your performance duties are in the corporation, because it could be different. You could have 4 officers, but one just sits around and collects a paycheck and does nothing. One busts their butt and does almost everything, and the other 2 are just kind of like extra signers on a checking account. So each of their reasonable compensations for that corporation is going to be different because it's going to be based on their actual individual roles and percentages of time worked and hours and the whole 9 yards. So this analysis that you can do annually will actually address all of the areas in which tell you then what you have to pay yourself in reasonable compensation. And I say have to because if you're audited and you didn't pay yourself reasonable compensation, there are penalties and consequences for this. Also, in addition to that, a new regulation is mandating that tax preparers have proof of reasonable compensation before filing tax returns. in which case, if you cannot provide the documentation that you paid yourself reasonable compensation and here's my proof, they may say or elect to not file your tax return because they can't put their name on it without the proof that they're supposed to have. A lot of tax preparers do perform reasonable compensation analysis. Others don't. Our firm does, our consulting firm actually does prepare them for you and offer them to you. And of course, we offer it to all of our customers as well. They don't have to come through us. They can go anywhere they want, but we do offer it. It's an analysis of your roles, your duties, the time you spend, and then you spit out the result. Only after you have paid yourself reasonable compensation, the real, like truly, are you able to then take distributions. So a distribution is a benefit, a perk of being an officer of a corporation. You can take both payroll and distributions. Distributions, you do not pay the Medicare and Social Security taxes on. So it's part of a tax planning strategy to help keep more money in your pocket to take your distributions, right? And so you can take them only after you've paid yourself reasonable compensation, which means at the end of the year, that's why we're talking about this now, because now's the time to figure out, have I paid myself reasonable comp for this year, 2024? Yes or no? If I haven't, what do I need to pay myself to be up to the right amount to pay myself by the end of 2024? The good news is, as an officer, you don't have to pay yourself like per pay period or in a certain range. It just has to be by the end of the year and what's on your actual W-2 at the end of the day. So a lot of owners will do reasonable comp and then either pay themselves up at the end of the year in one lump, or the next couple checks for the rest of the year, they increase the amount if they need to. Then you can report distributions. If you've reported distributions and not paid yourself reasonable compensation, your distributions are supposed to be reassessed as back payroll taxes that are due. And in an audit, that's exactly what's going to happen. And the reason I can tell you this for sure is it's happening to a client as we speak. So my poor client is one of these companies that has just going, and all of a sudden one of their employees decides to make his life miserable by claiming at the Department of Labor something wasn't right, and so now he's in this audit, right? So that doesn't mean that wasn't triggered by anything on the accounting end being wrong, a tax return, nothing. That was just a happenstance situation. Now, in the audit for state unemployment, because it's an unemployment audit, the auditor has now requested all kinds of documentations. And if you've watched our mini masterclass series, you've heard us talk about employee versus contractor. You've heard us talk about 1099s. You've heard us talk about now reasonable compensation, distributions, owner's pay, all of that. And this audit is living proof that it matters, because it started out as one type of audit, but throughout the audit process, he's being asked to provide all kinds of documentation. And one of the things currently requested is proof of reasonable compensation. Because I'm telling you, one hand is going to start talking to the next. If it starts out one way, but they think there's something different over here, at the end of the day, the agency's role and duties is to find tax money that hasn't been paid, to get the tax money that hasn't been paid, and then to collect interest and penalties because it hasn't been paid. So they're going to do whatever they can, whatever scenario you're in an audit, to find more and more and more, because that's ultimately their job. Their job is not to hound you and make your life miserable and make you hate the government. Their job is actually to just make sure that you're paying your taxes and you're doing things in compliance for the entity selection that you're in. And the reason that you've probably elected an S Corp or S Corp elect is because you want the tax advantages that come along with that. So they're like, okay, we're giving you these tax advantages. You need to follow the rules. Otherwise, you don't qualify as this type of entity, because you're transacting as if you were a sole proprietor or another entity type that doesn't get these tax advantages, doesn't qualify as such. So then they can reassess all your taxes and say, you got the tax advantages, but you weren't transacting as if you were a corporation. So really, if you were an LLC or a sole proprietor, you would have been taxed this way instead of that way. And now you owe us back taxes on all that stuff. That's what ultimately can happen. And that's why this matters and why you need to take it seriously. I do have several people, or I've talked to several people over the years that are like, I can't afford to pay myself because we don't have the cash flow, or because we don't have. There are still things you can do, like turning your wages, your unreceived wages, into a loan to the company. So you're still reporting and paying taxes on them, but you're not physically taking the cash. I know that sounds counterintuitive, but it actually can be a strategy for you. You also can, by doing the reasonable compensation analysis, you also can show, look, we don't have the cash. Yes, I do these things, but here's an outlining circumstance that proves that I can't actually give it to myself yet. And there you have your proof. As long as you have a documentation that's IRS compliant, that shows that there's a reason you didn't pay yourself, then you're golden. Now, if you don't have enough money to pay yourself, you also then don't have enough money to take distributions. Get where I'm going here? You can't decide, I don't have enough money to pay the payroll, but I do have enough money to take money out of the business. You then need to take only money out of the business via payroll before you do any distributions whatsoever. So, hopefully that helps clears up. I know there's lots of people that say, how do I know how much to pay myself, when to pay myself, all of that. This only applies to officers, corporate officers. So if you're an S Corp elect through your LLC, or you're an S Corp proper, a C Corp proper, this applies to you if you're the business owner / officer. It doesn't apply to every single employee that you have working for you. If you're a LLC or a sole proprietor without the S Corp election, you don't need to do this. You can just keep taking your draws, and there's no stipulation around you paying yourself a specific amount over the course of the year. So now again, remember, it's over the course of an entire year. You could elect to pay yourself once a quarter. Just in June and December, you could just say, okay, I've paid half my money now and I'll take the rest in December. Highly suggest you doing a tax planning meeting, a tax strategy meeting, so that you understand everything you have to understand around why you would pay yourself, how you can pay yourself, strategies and tax advantages and things that are out there to help you that you may not know about. We are offering a fourth quarter promo for the reasonable compensation analysis. Is if you haven't done one, reach out. We can send you more information. You don't have to be a customer of ours on a daily basis to get these done. We can do the analysis only for you, and at least you would then have proof, and you can update your information on the back end through your payroll provider. So that is everything about reasonable compensation, what it is, why it's there, why it's important. It is just basically a report that shows the basis on which you pay yourself this much money based on your activities and your time in your corporation. It should be done annually because business ebbs and flows. 1 year, and I've seen this every year. I see this with my customers. 1 year it's going to be like this, and you're like sailing high and you're on the moon and everything's going great. And then the next year, something tanks, a product tanks, a service tanks, you have massive turnover, you get into a new market and it doesn't work the way you thought it was going to work, and it costs you all this money. So every year is the way you should do it. Just like you should get new W-9s every year from your contractors and new W-4s every year from your employees, because things change. People, their deductions change, their entity selection changes, their addresses change, their marital status changes, their dependents change, you name it, things change day to day. So get these documentations updated annually, and there's no time like the present. It is October 23rd-ish, I think, and we are going to blink and it's going to be over. Fourth quarter is going to be over. The holidays are coming. Halloween is next week. Oh my Lord. then Thanksgiving, then Christmas, then New Year's, and then it's too late. Then it's done. You don't have the time to say, oh, okay, I need to make up my reasonable compensation for the year, or I need to do this or that. So do it now, get those tax planning meetings going. But if nothing else, let's do your reasonable compensation analysis so that you know that you're on track for 2024. And it will help you understand more about what you need to do in 25 so you can set your budgets against it. You can understand how much you need to bump your payroll if you need to. You can be compliant from the start instead of waiting for October 23rd and Sam to tell you that you need to do this or that. And then you go, oh God, I don't have that much time to pay myself an extra 50 grand, right? So reach out if you have questions. We appreciate you joining. Come back and watch the replay if you've missed some things, or you can find us on our YouTube channel or on our LinkedIn. I hope everyone has a very safe and wonderful Halloween. It's 1 week away. I'm hitting the road tomorrow. I'm going to South Carolina to speak at a women's accounting conference, and then directly after go and speak at Intuit Connect, which is the annual Intuit conference. And it's my very first time speaking, so I'm super excited. I'll show you guys all around and tell you all about it. But thanks for coming and watching, and we will see you in 2 more weeks for our next mini masterclass. Bye.